Morgan Stanley reported its Q2 earnings on July the 14th before market open. Today, I'm going to be talking about how I traded Morgan Stanley earnings with an iron butterfly strategy. The company reported its earnings for the quarter ended in June the 30th on July the 14th before market open. The analysts' estimated revenue was $13.50 billion, down 8.8% from the previous quarter. The anticipated EPS was $1.61, down 21.8% from the last quarter. The reported revenue and EPS were $13.13 billion and $1.44, missed analyst estimates by 2.71% and 10.40% respectively. On July the 13th, before the market closed, I opened an iron butterfly position as it shows in this chart. The max profit for my trade was actually $275. The difference is due to the delayed data fees. Iron butterfly is a direction neutral strategy, so I'd be profitable if the stock price moved between a break-even points, which were $72 and $78. Morgan Stanley stock hovered around $75 before market closed on July the 13th. The at-the-money straddle expired on July the 15th was priced at $3.50. This means that the Morgan Stanley expected post-earning price move was between $75 plus and minus $3.50. This is known as the implied move. And if you're not familiar with the concept, check out the link in the description section for a reference. During the last 4 earning events, Morgan Stanley post-earning stock price all landed square in the anticipated move. This indicated that for Morgan Stanley, the market tends to overestimate the actual move after the earnings announcement. Going into the earnings, the sentiment for the banking sector has been very negative. Morgan Stanley stock had been plunging over the last 3 months, while the implied volatility has also been ramping up. So now we've seen the historical moves, the implied volatility, and also the recent price actions. I perceive these as signals to short both Vega and Gamma, which means that I'm expecting the volatility will be crushed. However, the stock will be barely moved after the earnings announcement. Morgan Stanley stock dipped after market open amid its worse than expected earning results. On its way down, I decided to close my call side with 28 cents of debit. Given the initial $1.31 of credit collected from the call side, I realized about $1.03 of profit. Around 9:45, the stock price hits its daily low around $72, close to the lower end of the anticipated move. Then around 9:45 a.m., the stock started rallying back up. So I decided to close my put side when the stock price hit $74 for the first time. The total debit I paid was $1.40, which was roughly the same amount of credit I collected initially. So I was break even on the put side. In conclusion, I risked about $220 to get a $100 profit, although the calculated chance of profit was only about 50%. With the historical implied versus actual move data, I was able to have a higher conviction with my trade. Morgan Stanley was closed at $75 on July the 14th, which led to a non-mover situation compared to the close price from the previous day. This behavior aligns very well with how it performed historically after the earnings announcement, so I'm very likely to place the same bet in the next round of the Morgan Stanley earnings announcement. If you like this video, please hit the like button. We will continue to publish trade research like this, so please remember to subscribe to our channel. Hope you find this helpful. See you next time.